Now, without further ado, I would like to present Fred, who is, I'm actually waiting for his presentation, so it's going to be a bit different to what we've heard so far. Fred is the president of the Fred Report and has been practicing technical analysis since 1983 and has worked in the research departments of Merrill Lynch and Smith Barney. In addition, he has worked as a portfolio manager and financial advisor. His presentation today is on smart beta versus cap-weighted indices, cap-weighted ETFs. So, without further ado, Fred.
Cool.
Thank you very much.
No, thank you very much. And a couple of things. First of all, I don't know how much everybody knows about smart beta. Smart beta in the United States is the next big thing, okay? And the one thing I didn't do when I was putting this presentation together was define smart beta. So I shall do that first off, okay? A smart beta is essentially breaks the link between capitalization and an index. In other words, you build your own intelligent index to accomplish whatever it is you want to try to accomplish, okay? S&P, the indexing company in the United States, has been building smart beta indexes for 30, 40 years. They have data on these. But just recently, really in, say, from 2005, 2006, some of the ETF companies have started using these indexes to build trading vehicles. And when you think about it, it makes sense to do this, okay? It's not active management, but it's not just passively imitating an index that was built by somebody who never, ever, ever thought that that index was going to be traded, okay? So what I'm trying to do in this study, and I already told Alex, this is the first time I've given this presentation, and I did not do all the math that's in the study. I have a math guy that works for me, and he did a lot of the mathematical calculations. So please, if you have any questions about the math, ask Alex, or tell someone else. And if you have any real questions that I can't answer, I can actually get Lou on the phone or text Lou because it's early in Arizona, and he can probably respond to that question. Or I'll get you a written response to it. So let's see how this goes. This should be very interesting and fun. First of all, my company, the Fred Report, our client base is basically portfolio managers and a lot of discretionary financial advisors with major brokerage firms. The big thing in the brokerage business now in the United States is portfolio managers that build their own models and have discretion, i.e. you don't call up your client and say, I'd sure like to buy XYZ. And the client goes, yeah, let's go ahead and buy that. Now they just do it and they have a review 2, 3, 4 times a year. So we publish research for that type of client. We have clients at every firm now. Dorsey Wright is a research firm that does a lot of relative strength analysis, and we look at one of their ETFs in this study. If you want to get a free trial of the Fred Report, you're welcome to do that, and I'll be glad to help anyone do that. Okay, basically, these are the ETFs we're going to look at. PDP is an ETF that is based on relative strength. SPLV is a low volatility ETF that's designed to be less volatile going up and going down than the market as a whole, which we measure by SPY, which is the cap-weighted index. And then RSP is an unweighted S&P 500. Are people at all familiar with any of these indexes here?
Just the RSP.
Just RSP, okay. You're going to be seeing some of the other ones, and we're going to take a look at them all because there's some interesting things about them. Okay, this is how my dear associate Lou calculated beta. There are basically 3 betas that we're going to use. One beta that is applied to the entire study period, then a beta going up and a beta going down, okay? Which makes sense if you're trying to mitigate, say, the effect of a decline or create more alpha on an advance. And we've got charts and stuff of all this, so let's go right into what we've got here. This was the study period, July 7th, 2011 through April 2nd, that should be 2018, not 2108. I shall change that for the next report. The reason we started in 2011 is, frankly, SPLV, which is the most interesting of these ETFs, started in 2011. Okay, RSP was a little bit longer, PDP, the high relative strength ETF, was a little bit longer, I think 2009, 2010, and RSP, the unweighted S&P, has been around forever, I believe. Trade Levels in Southern California did an unweighted S&P, and of course Marty Zweig did ZUPI, and which was the Zweig Unweighted Price Index. And Alex, you asked me a question early as to why there are not more technicians running around on Wall Street. And certainly one of the answers that I forgot to give you is when technicians invented unweighted indexes, they called them things like ZUPI instead of smart beta, which sells, right? We are not, as a group here, and a group of technicians, we are not the world's greatest marketers. I think that's really clear. So let's take a look at some of this. On RSP, you had slightly better performance and a beta of 1.07, but it did less well than its average would imply, okay? Now, this is actually very interesting, and this is where technical analysis actually can be a help in choosing which of the smart beta ETFs to use. Because the great thing about smart beta is that it avoids something that happened to me as an investor, okay? Smart beta, you have a formula for how the index is calculated and the ETF is created, and then it cannot deviate from that, okay? Whereas if you have a mutual fund that is, say, a high dividend growth fund, and that manager leaves, the next manager may not manage it the same way, and that can all change, okay? And they usually, by the way, do not call you up and tell you, we changed managers and your fund has changed. You find that out after a period of underperformance, okay? That's what happened to me. So when I saw smart beta ETFs, I thought that's great. It's rules-based. What you see is what you get. But we all know as technicians that at the beginning of a move, it's more broad-based. The advanced decline line does better, breadth indicators do better, and that sort of thing. So if you think you're at the beginning of a big uptrend, it might very well be better to buy RSP than SPY or one of the other indexes. If the move has had several corrections and your breadth indicators are starting to look a little bit shaky and you're starting to see some divergences, RSP may not do as well, and you may not want to own that one. So one way to use smart beta and technical analysis that we will revisit in the study of some of these other ETFs is use your indicators to determine which one of these you want to buy. Oopsie, home. You told me not to hit home. Sorry. Okay. Here is a bar chart basically of the performance in up and down markets. And what you can see is, again, at the beginning of a move, and we can really see that in this slide, okay? In the beginning of an advance, RSP does much better. At the end of an advance, it does not. So another way that you can use this as an indicator is to watch the performance of the two. And when the performance of RSP starts to lag, that's an indication that you're getting close to the end of a move. Okay? So in other words, what the brokerage community would want you to do the ETF sales community, if you will, a company like State Street or my sponsor PowerShares or whatever, would want you to do would be to just buy the ETF and sit there and let them collect performance fees. But you can actually use these as an indicator and swap around between them. Okay, then we'll go back here and look at this beta, and you can see again, SPY performance throughout the move, it changes. Okay, now let's take a look at PDP, which is an interesting ETF that doesn't do as well as RSP and some of the other ETFs. And let me talk about how this is calculated. Dorsey Wright, are people here familiar with Dorsey Wright, the service? Okay, you are. Okay, you are. Dorsey basically uses point and figure analysis, and their primary goal of using their analysis is to find high relative strength stuff. Now, Norman Fosbach and other technicians will tell you that relative strength is one of those things in the market that quote unquote works, okay, over long periods of time. But the question is, how does it work for trading or for shorter periods of time? The way I explain it to my clients, because I'm not a relative strength analyst, I tend to use juncture recognition and some fundamental considerations to determine what I want to buy, if anything. The best example that I can give you is, let's say you've just gotten a buy signal on markets, okay? And you're trying to figure out, do you want to buy small cap, large cap, mid cap, or whatever, okay? With relative strength analysis, you have to let that move go for a while to determine which is the leader and then buy the leader. And the problem with that is, the longer the move goes, the closer it is to being over, okay? And in this kind of environment that we've had, sometimes 50% of the move is over before relative strength goes. So what I do in my service is, at the bottom in 2009, 2010, coming out of that, I did a study with a PhD that basically showed that when you're coming out of a recession and the unemployment rate is going down, small cap leads 100% of the time. Okay, so if you look at the economic indicators and you figure, golly, we just had a big recession, the unemployment rate is at 9%, and in the States it never really goes above 12 and is starting to drop, forget about relative strength analysis and just buy small cap, okay, because that will lead, okay? Then we'll use relative strength as an indicator to essentially say, yeah, this is working or not. And that's what happened with PDP, which uses Dorsey Wright's point and figure methodology to calculate relative strength. It lags in the first part of the advance when RSP is doing better. It leads in the second part of the advance when RSP is doing worse. So how many people think that if they knew that, they would probably buy RSP at the beginning of an advance and then swap when RSP starts to lag into this? That's a way to use smart beta that they don't tell you about, but technical analysis can help you pull that by taking a look at relative strength, relative performance, and the breadth indicators. Okay? Obviously, PDP matches the Dorsey Wright Technical Leaders Index. That's not surprising, but it generally lags the Russell or the S&P. Now, realize here also, folks, we are talking about 4 ETFs. There's an ETF for small cap relative strength, okay? There's a small cap unweighted index that's the equivalent of RSP. So in the States now, this has permeated everything, okay? So let's have a look. Here is your performance compared to beta. And let's have a look. That's up and down markets. Let's have a look. First of all, this is during the advance, and you can see PDP's performance improved at the end. And let me just scoot a little bit here. There are the quartiles and stuff on the bottom, which is the other way isn't showing. But this lags at the beginning, leads at the end, okay? Just like a lot of relative strength things do. You know, again, William O'Neill is a friend of mine, okay? He's one of the people who got me started in this business. But how many of you guys have read his book on CanSlim? Is everyone, yeah, you've read it. When CanSlim is really working well, the bull market is just about over, okay? And that's always been one of my favorite indicators, is when you start to see the William O'Neill stuff work really, really well, the move is very close to being over, okay? And that's nothing against Bill O'Neill. CanSlim does what it's supposed to do, but that's an excellent indication for that. And you can see again going back, and I'll just scoot a little bit up. There's your quartiles. You can see SPY doing better on these in declines versus advances. So again, I have only done performed this once in my head. Okay. Now, the most interesting of these ETFs for me is SPLV. This ETF filters for low volatility, and I'm going to tell you the formula that SPLV uses to create a low volatility instrument. They take the 100 lowest volatile stocks in the S&P 500, as measured by 1 year standard deviation, and they rank those in order from least volatile to most volatile. In other words, the least volatile stocks in the index get more money than the most volatile at the end. And then they rebalance that with a 12-year look back every quarter, okay? Now, one of the things people have objected to with SPLV is there are no sector constraints on that index, okay? So it's theoretically possible to have 80 of the 100 stocks be utilities, except there aren't 80 utility stocks, but the whole utilities index can be part of SPLV. There is another low volatility method. The symbol for that is USMV. And that's got a much more complicated formula, but basically that forces you to be in all of the sectors, but ranks each sector by volatility in a way so that you can theoretically select the lowest volatility stocks in the sector. The problem with that is when you end up with a decline like the tech bubble or the 2007 to 2009 decline in banks, you may be in the least volatile tech stocks or bank stocks, but those still go down a lot more than the market does, and you get hit. So I tend to like how this index does, okay? It was designed to capture 70% of the upside and 25% of the downside, and it basically does that, okay? So if you have a customer that doesn't want volatility in his portfolio but wants to be in it, if you have a guy says, golly, the market's gone up for 9 years and now I have to invest in stocks and I'm scared, this is the sort of instrument you can use. One of the things that I have recommended, it's not part of this study, but I'll tell you about this ETF anyway, is there's an ETF SPHD for low volatility, high dividend. And what that ETF does is it screens the 75 least volatile stocks and then picks the 50 with the highest yield. And that's designed, and in fact goes up about 65% and down about 35% of the S&P. So it's not quite as volatile as this, but the dividend yield on SPLV, the last time I looked, was around 3, and on SPHD it was around 4.5. Okay, so where some of my clients are using this ETF is the idea that they are scared of interest rates going up, but they're also scared of buying stocks, you know. And I've got a study on my computer, which I'll be glad to show people afterwards, showing that in, I think it was 98% of periods of time when rates were rising, dividend stocks outperform bonds, okay? So the question is, and the way I did that study, by the way, one of the things I absolutely hate is someone says, I'm going to do a study, I'm going to take 5 years worth of data and come up with a grandiose conclusion. The way I did my study to derive that information, and if anyone wants it, email me and I'll send it to you. I figured that the best proxy for income stocks was utilities. And so I took the utilities index back to 1929, 1930, I think it was, when it started, and compared it to AAA bond yield. So I feel quite satisfied that when I say that, I've done a study that is actually thorough and it works. But we don't have to just use utilities for income now. You could use something like SPHD, and actually, one of the killer buys that I recommended, that I own myself, disclaimer, I own this myself, there is a low volatility, high dividend, small cap index, and we all should know that the US small cap indexes are hitting new highs daily now. Okay, and XSHD for low volatility, high dividend is probably going to end up being a very good thing to play as small cap takes off and hits new highs.
Sorry, what was the ticker again for that?
X is in X-ray, S is in Sam, H is in high, D is in dividend.
Thank you.
And of course, there's also XSLV for low volatility small cap. It's really gotten to the point in the States where you just have to know what you're going to be talking about because there's so many of these damn ETFs. Reminds me of at the beginning of the tech bubble, after I quit Robinson Humphrey, like I was telling you, I was sitting in the whirlpool at my gym, and some guy says, oh, I'm not worried about the market now. I'm completely diversified. I own over 30 technology stocks. I didn't say much, I just said, that's very nice, you have a good day there. So, let's see how this is done. But SPLV is probably, of these, the most useful standalone solution for you guys here. Okay, in other words, if you're looking for something that really is lower volatility, this is. And by the way, for all of these ETFs, if anyone is interested, S&P will give you the data on a lot of these going back 30 years so that you can calculate and play with the data yourself. The individual ETF companies, PowerShares, for example, does, which is Invesco, does SPLV. They're not allowed to provide you with the index data, at least not in the United States, but S&P will provide it, and I can arrange that if anyone's interested. But here's how it does. SPY performance versus the S&P 500, which is SPY. You can see basically that SPY has consistently done less than the S&P 500 in both advances and declines, which is, of course, why you would buy it, is because you would want it to do that. And let's go on to the next slide here. Here you have the two advances. Again, in a broad-based advance, the S&P 500 in a real trending move will do much better. But SPLV will participate, okay? And in the declines, you can see it declined less, and that's exactly what you want it to do, okay? It did underperform the S&P, but it's designed to underperform the S&P, so I wouldn't hold that against that ETF or that product. Okay? And let's see what else we have. Okay. We will take a look at these on a quarterly basis, and then I have sort of a historic study that I did you know, again, as a technician, you think in terms of market timing. Can I use this stuff to time markets? And as it turns out, I'll show you the study I did, you can't. But there's a reason for that I think we can talk about. Okay, here's quarters where the ETF went in the opposite direction of the cap-weighted one. Okay, not a lot, 12 occurrences in all that time. Okay, it's worth noting that the S&P, SPY, had better performance. The cap-weighted index had better performance during that time. Now, the relative performance, ETFs only beat SPY in 40% of the time. 41% of the time, you can see, but PDP, the high relative strength one, really only worked 33% of the time. And that's, of all of these, PDP is the one that I don't use unless I'm real satisfied that I want to use it. And what we're going to do at the very end of this is we're going to look at daily charts showing recent action of all of these, because of course, as technicians, we are chart readers. We can look at the chart and say this one looks better or worse, and not necessarily worry just about the smart beta component of these. So let's take a quick look. Okay, here's your daily chart. That is a cap-weighted S&P as of a few days ago. And obviously you can see your stochastic at the bottom, you get a nice little buy signal, comes up to the top. In other words, this is tradable. Okay, it obeys the trading rules. And what I told Alex but have not told you, the main indicators that I show and teach my clients to use are a combination of moving averages and the stochastic. The moving averages I use are the 5-period and the 20-period. The reason I say period, obviously I use these on 30-minute charts to monthly charts. Okay, the 5 and 20 give as good a set of signals as you're likely to find from a dual moving average crossover system. They are not perfect, but they do a good job. And my goal as an investment recommender is to find a time when the stochastic is down here and the moving averages are negative, buy it, and then hopefully the moving averages will go positive soon after. One of the tricks to utilizing this methodology is the sooner, and we all know how to use the stochastic, below and above 20, above and below 80, the sooner the moving averages cross after the stochastic gives its signal, the better the move is going to be. So in other words, down in here, you got your stochastic and then your moving averages crossed right away. Up in here, you didn't, so that move has a better chance of being a dud. And that's basically, in a nutshell, for these purposes, how we looked at these things and what we do. So there's your S&P 500. That's the cap-weighted index. The next one is PDP. Now this is the high relative strength one. Again, you're closer to the end of an advance, but this is almost making new highs and is based on S&P stocks, basically. Okay, so this slicing and dicing of the S&P produced high relative strength stocks and late cycle leadership that has it doing better than the cap-weighted index. Here is SPLV, and you can see it's been less volatile, but it's also a lot further from the high than PDP is, right? That's one of the things you're giving up when you choose to use that. And then here's RSP, which again, we said works better at the beginning, less well at the end than PDP, and it's also done less well. But again, all of these are tradable using the indicators that we use. And one of the things that I do, honestly, this is going to sound sort of dorky, but is everyone in here familiar with the term plunger? Okay. When I buy something, I like to buy a lot of shares. Okay? So if someone were to ask me the question, would I rather buy something at $50 a share or $250 a share? My answer is, all things being equal, I want the $50 one and I want to buy 5 times as many shares, i.e. leverage, okay? It should not be lost on you if you're trading that this thing is $55 a share and the S&P is $272 a share. And it does pretty much react, as you can see, to the indicators exactly the same way. So that's just another point to using this. In other words, you can find a cheaper instrument to trade that's going to trade more or less like the S&P. And again, if you know that this is going to do better late cycle, and you think you're late cycle, this is actually a fairly good thing to play and use. Now, I'm going to show you something that I tried to do and failed horribly at, so that you guys don't try to do this and fail horribly as well. Okay? We had some timing portfolios that basically toggled between low volatility and high relative strength, or alternatively, high beta and low relative strength. I'm not showing you the ETF for high beta, but the way that ETF, I'll give you the symbol for that. It's SPHB as in beta, or boy, okay? That is designed to go 150 times the S&P. So if the S&P is 100, this is going to do 50% more. And guys, there's times when it really does that. At the bottom in 2011, when the market turned up, I bought SPHD on margin, okay? Which is not something that anyone in here, unless they're very confident of their abilities and risk management, should ever do, because it goes down 150 times as fast as well as goes up 150 times as fast. But that thing doubled in 3 weeks, and I sold it and got off margin, okay? And that's where I got the idea for these timing models, switching between high beta and low volatility. What happened here was interesting, okay? The ETFs performed the way they were designed, but because the market and psychology was such that people weren't buying high beta stocks when they were supposed to, and instead remained defensive for too long, the high beta stuff didn't actually work except at the very beginning of some of the moves. In other words, when I did my little maneuver in 2011, I was actually lucky and not smart, okay? If I'd been smart, it probably wouldn't have worked, but you can see how this is. For example, emerging markets, low volatility in 2011 outperformed high beta because it was the defensive stocks that did better, okay? Both lagged just the general benchmark by 6 to 8%, okay? So here is Lou, my mathematical guy, who, by the way, I paid reasonably well and I've worked with for years. I don't know what I'd do without Lou. But he went through and created a best timing strategy. In Q1, EEM was up 6%, but actually you wanted to be a bear because low volatility gained 11 because everyone was defensive, okay? That was exactly the opposite of what was supposed to happen, but it did happen nonetheless, okay? In the second quarter, EEM was flat, but the best timing system was to suddenly switch into high beta and high relative strength because the market had suddenly gotten convinced, since you had a move, that the market was going to continue to do well. And so you can see here, high beta worked better, okay? EEM in Q3 was up 9%, and the best timing system, since the move had been going on for a while, remained bullish, okay? And actually did pretty well, except that EEMO, which is EE high momentum, underperformed EEM. So the momentum stocks did less well, okay? And the reason I chose this particular thing, by the way, I happen to believe myself, whether I'm right or not, I don't know, that emerging markets have a better chance of seeing something like this work because there's less price discovery. Nothing's arbitraged away because there's not that many people in these names. So this was a really good test, okay? In Q4, EEM was down 5%, and EELV and EEMO both underperformed. High momentum and low volatility underperformed. Okay, in other words, what you're seeing here, and we'll show you the slide, none of it really made sense in terms of the way it worked. You have to use, in other words, what I got from this was looking at some of the fundamental conditions, looking at the charts of each individual index and knowing where you were in the market cycle, and then knowing how each ETF was supposed to perform in terms of where you were in the market cycle was more important than saying I'm going to be really bullish or really bearish here. Pretty much the best timing cycle, BTS worked, or best timing system worked 2 out of 5. Not great. So we dropped the timing models because people, it was too hard to do and the results weren't there. And then this is vitally important, the cartoon. Can everyone see the cartoon? No. It's a Dilbert. It says, you should buy a stock whenever the chart looks like a squirrel sitting on a clown's shoulder. That's called technical analysis. Guy says, I'm not going to do that. And the response is good, because it doesn't work if everyone does it. Okay? I've always loved that cartoon. Okay? And that essentially is the gist of this presentation. How long did I take? About 45 minutes? Yep. Good. Any questions for me on anything about smart beta or technical analysis or the MTA, which is now the CMT Association, that I might be able to answer? And obviously Alex has this handout. He is more than willing and able to send it to anybody who wants it, and of course I will send it to anyone who wants it as well, and get you the ability to talk to the people at S&P so you can get back data if you want to explore this more. It sounds like, Alex, you don't have like the English stock market, high beta, low volatility, unweighted, high relative strength types of indexes yet, but you will probably see those in the next few years if you do not have them.
Yeah, most likely.
Yeah, this stuff, they're really trying to, all of the firms, what basically has happened in the marketplace is PowerShares, which is my sponsor, which is the biggest provider of the smart beta ETFs, they made such heavy inroads into the market in terms of sales that companies like iShares and State Street are now trying to introduce smart beta ETFs to catch up and siphon off some of that gain. ETF growth in the States has been, I think it's doubled every year, and smart beta has been half of that doubling. So it's been a big gain. And that's why I think you'll see it here. Any questions? Yes, sir.
Apart from towards the end when you were talking about emerging markets, you didn't, I think, talk about momentum factor, ETF factor, which has really been the winning one in the last.
That's been the winning one. That I dropped this whole timing model thing immediately before the momentum factor worked. Okay, and I can tell you, talking to some of the other ETF strategists, everyone was looking for the factor that was going to work, and that can change based on markets. I am using in my models for emerging markets, I'm not using EEMO, which has been the biggest performer. I'm using now PIE, which is high relative strength, figuring that relative strength may start to take over as the market thins out. But yeah, and of course, forgetting, we're technicians, right? That's what we are, technicians, okay? All we had to do was look at the charts of EEMO, EEM, PIE, EELV, and all of the factors, and you could see on the chart, as plain as the nose on your face, that momentum was the leader, and that was the one to buy. So you can even use the relative strength of the factors to try to pick the factor that's going to do the best. And that actually may be the best way to do this. Did I answer your question?
Yes, you did.
Yeah, you're not supposed to do that if you're an ETF strategist. What you're supposed to do is say, I think because of my fundamental analysis that low volatility and defensive stocks should work better. So that's the one I'm going to do. But really what you want to do is look at the charts, maybe create, I just thought about this for the next iteration of this presentation. I might actually put in relative charts of the three-factor ETFs, say compared to EEM, or the three-factor charts compared to SPY, for example. That might be another way to present the data. But that certainly would have worked in this instance. Other questions? Very good. Thank you. Was that okay?
Yes.
I never did this presentation before, so you always want to.
How do you deal with boredom? I look at the ETFs; they have no boredom.
This is exactly what you do.
But you cannot buy 50,000 shares of X.
You can. It's very easy. I will tell you what you have to do though. Remember that when you buy one of these ETFs, you're actually buying a basket and not an individual stock. So you have to use a limit order. And the firms will, at Merrill Lynch, Morgan Stanley, PowerShares, they will create 50,000 of these. As long as the underlying shares, those underlying markets are liquid, even if it has no volume, it's easy enough to get at a price. Okay? The trick, and this is big time, because I've seen people get absolutely pounded on this and unnecessarily. If you want to buy a Chinese momentum ETF, there probably is one, I don't know what it is, but if you want to buy something like that, you want to try to buy it when the Chinese market is open. So the market maker can create the ETFs for you, okay? You don't want to try to buy it, or even worse, sell it when that market isn't open, because the market maker is going to add a premium on that price, which means you're going to pay higher or get lower if you're selling it, to manage their risk as market makers, okay? But rest assured, and if you're an institutional guy and you really want to know about this, I've got a guy in Chicago that runs the PowerShares desk that will tell you much more about this than I can, much more. I mean, that's what he does every day. But it has never been a problem. I use the small cap sector ETFs. I have a small cap sector model that has beaten IJR and IWM by about 6-7% a year. Okay, overweighting and underweighting small cap sectors. Some of those are very, very thin. Those, because frankly, until very recently, nobody but me had any interest in small cap energy. Right? I was the only one. Right? People say, why are you recommending that? It's in the 12. Well, turned out it went from 11 to 18. Okay? But you could buy it. I had a guy buy 40,000 of them, and it didn't move the price. Answer your question? Yeah. But, and if you're really interested, talk to Grayson. I'll get you his phone number. Yes?
Can we buy these ETFs on any sort of exchange?
They're all exchange traded funds. You can buy them on the New York Stock Exchange in 9 out of 10 instances. Now, the one thing, of course, I didn't ask, Alex, is are they approved for you guys to buy here in England? Okay? Yeah. But I would assume they are if you know what you want, right? And this is going to happen to you guys here too. I bet in the next 2-3 years, you're going to see a lot more of this. Yes, sir?
But on the exchange, when we buy them, are we still dealing through a market maker?
Yes, you are. You have to, well, I was about to say you have to deal through a market maker. That is not true. There is a secondary market in the very volatile ones, okay, and the ones that have a lot of volume. But if you put in a limit order, you'll get your price. And honestly, I don't know whether you'd even be able to find out if some were created and some were secondary or not. Does that make sense?
Are you a market maker?
No. No, but I have friends that are. Okay? That's how I feel. You know, I feel very confident that the market makers for these things can do the job. You know, it's big firms like Merrill Lynch and Morgan Stanley. I mean, unless you're trying to buy hundreds of thousands of them, which I've never had anyone do, there might be a problem there. But again, if the underlying is liquid and the market is open, right? The thing you don't want to do is put a market order on the open end, because under US regulations, and I don't know if this is the same, Alex, if you put a market order in, you have to get the next price it prints, right? And on something like this, especially if it's something like FXI or GXC, which is China, and China's closed and you want the next price, market maker's gonna see you coming, okay? But if you give them time and you give them a limit, and if you put the order in when it's open, I've never had anyone have any horrible trouble. Yes, sir. Sorry.
It's an open question. Eventually, are there traders or strategists or algorithms that are trading the relative value between the PDP and RSP?
There might be, but I don't know about it, but it wouldn't surprise me if there were. I think there's traders that are trading that sort of arbitrage between everything that moves.
Only longer term scale, yeah?
I've never heard of
Or
that.
intraday, basically.
I would think it would be mostly intraday, but I don't, you know, it's hard enough trying to trade something algorithmically that's not a basket of 100 stocks that all have to come together to be a price, right? That would seem to me to be hard to do, but I don't know that much about it, honestly. But if you put, you know, maybe with RSP and SPY, which are both the same baskets and relatively a lot of volume, relatively liquid, maybe. But you know, I think you probably make more money as an algorithmic trader trading just the stocks and not trying to trade the index.
So the other question was basically, if you're looking at the timing of the cycle, it's possibly better to use them as an indicator where you're standing on the S&P cycle.
Yeah, that's
You know, that might be what you want to do. I think that's a matter of taste. You know, the problem, especially with the relative strength ones, and this has happened to me with relative strength myself, is I invariably buy something that's high relative strength just before it stops being high relative strength, right? I mean, right at the end, there I am with my work, okay? So I tend to try to buy something on the merits and use these as an indicator, right? But if you're really good at picking relative strength stocks, for example, and I am not, and oh, by the way, the other thing that I didn't mention that you can certainly do and probably should do is look under the hood at these things, okay? And see which stocks look the best. I'll give you a perfect example of that. I bought 2 stocks where I've done this. Small cap industrials looked really cool a couple of years ago. It was a great chart. I was really excited about it. And the best looking stock in there was TTC, Toro Lawnmowers. Okay, friggin' lawnmowers. Who cares about lawnmowers? Stock went from 20 to 120. I think it was just because it was in the index. I just bought a stock for my trading list, Neogen, NEOG. The stock went from 60 to 75 because it was the best looking chart in the ETF, and healthcare, PSCH, looked the best. So I picked the best looking stock in there and put it on a trading list. Okay, that's certainly another way that I didn't talk about to use these things, is to find the best stock in the best looking ETF and trade that. I mean, I was horrified Because of course I sold TTC at 60, up from 20, and watched it go to 120 and said, you know, I guess I should buy this back. But of course, like you do, you just say, well, I'll get around to that later. Yeah, and it's, yeah, but you sit there when you're looking at it, you go, who the hell cares about lawnmowers? Right? Lawnmowers. Riding tractors. Nice big southern lawns. Who the hell cares? But the thing went up huge, and I think it was just because it was in the index. So that's definitely something you would want to do. Other questions? Yes, sir.
Yeah, there's quite a lot of, maybe out of the thousands of US indexes, maybe most of them you would never touch. They're too thin to trade intra-month.
Yeah.
But they can be fantastic indicators to start off getting ideas about allocating to particular sectors and then switching into the more liquid stocks within them.
Yeah.
So you can really get to know which ETFs are more liquid and more differentiated, because a lot of them are overlapping anyway, and then get to know the bigger stocks, the bigger components, and the extreme components within those ETFs you want. And the liquidity can be quite strange. For example, the EEM is the 1/3 of the world which is emerging market stocks. It's basically mostly China, and yet it doesn't really, the EEM futures, the MSCI emerging market futures don't trade at all.
So that might be a way to do that. That's a good point.
And the MSCI EM, which is the EEM futures, only a quarter of the market cap is in US time zone, and yet that's where 90% of the dollar volume is. So liquidity can be quite perverse.
Yeah, and a lot of it is because some of these ETFs are now wagging the dog instead of the other way around. I mean, one of the problems I have personally with some of the iShares ETFs is they went in straight away and just duplicated the indexes, okay? Which meant that you were investing in a country that if someone had said to you, do you want to invest in Upper Volta? You would never invest in Upper Volta, yet there you are, right in there with Upper Volta, right? I was actually, believe it or not, in Mississippi, and some guy goes, what's Upper Volta? And I said, that's where electricity was invented. The guy goes, I knew it, volts. I said, yes, from Upper Volta. Never been back to that office. But that's one of the problems with these ETFs too. But you make an excellent point. I have never looked at any of the futures markets surrounding these because my clients don't do futures, and I haven't traded futures in many years. But you've got an excellent point. That may be what's going on.
And here's another point. It's actually, in many ways, much more convenient being any kind of money manager or trader in London than New York, because you have a 2-hour advantage for the US Open. Mm-hmm. But you also have the advantage that you're allowed to do CFDs, and spread betting as tax advantage is a subcomponent of that. So if you're in the States, the authorities patronizingly block you since the 30s bucket shops from doing CFDs. So we can do them, you can't. So we can do basically those ETF CFDs on quite a lot of, pairs trades, get a bit of leverage is useful. Portfolio pairs trades you can't, right, because you don't have the leverage.
I will remember that. I'll look into that. What is a CFD? Please excuse me for not knowing.
It's basically just a stock with leverage. Contracts for difference is
okay.
Over the counter.
It's an over-the-counter instrument that's created. And now I know what you're saying regarding the bucket shops, where you used to. I think in the bucket shops you would actually not buy the stocks. You just bet on whether they were going to go up or down.
And some brokers will give you the identical market of the underlying stock plus the leverage, and they just take the other side, which has the potential for.
That's not a good thing.
It has the potential for nefarious, whatever, to take the other side of it. But it's in practice, you can deal with that.
How?
Yeah.
But if they try to mistick you, the most common way they mistick you is massively increase the bid-offer spread size, so that the price actually doesn't change, but the huge bid-offer spread stops you out because your margin's calculated on the bid-ask, not the last trade.
Okay.
So you've got to know how to.
Yeah, if you know how to do that, that's something that's completely foreign to me. But when I get home, I'm going to call Grayson Lipton, the head of trading for PowerShares, and just let him know that that exists. PowerShares just bought one of the big, Invesco just bought one of the big ETF providers here in the UK. I had asked to see if their wholesaler could come with us to this meeting, and he was unable to because they didn't have a wholesaler. All right. So since PowerShares and Invesco were the biggest initial creators of Smart Beta, I have a funny feeling that in the next 6-7 months, you're going to see a lot of opportunities. So this may actually be quite timely as a presentation.
Oh yeah, we should. Any other questions before we round this up? None. If there are no other questions, we be having drinks afterwards.
I'm certainly able to stay as long as y'all need me to stay.
Perfect.
Just as long as
We can go up until 8:30 there, and then,
which is fine.
depending on the mood, we can go to another fine establishment around the area. I'm sure we're all been well known to do that. Okay, thank you very much for attending another chapter
Thank you for
meeting.
coming. This was a very